Hi friends, this is Brant Spesshardt with Steward Strategies, and thank you for investing some time as we talk about our 2026 first quarter economic review. Now here at Steward Strategies, we want to help our clients be good stewards and make wise financial decisions, and we truly believe that knowledge is power. Now, our financial plan contains a lot more than just our investments. We need to take in consideration these 6 key areas: retirement planning, investment planning, tax planning, protection planning, estate planning, and one of our favorite topics, generosity. Now, this quarter we saw a lot of volatility with the market. Both the Dow and the S&P 500 ended up in negative territory at the end of Q1. But they also saw all-time highs at the same time. There was just a lot of volatility. And some of the headlines we were paying attention to had to do with interest rates. The Fed met twice this quarter, but decided to keep rates the same. One of the things to keep in mind regarding the Fed is they're mainly operating on a dual mandate, meaning that they pay attention to inflation numbers and unemployment numbers. Those 2 factors are what really helps drive their decision to either raise rates, lower rates, or keep them the same. Now, the fact that the Fed didn't raise rates or lower rates doesn't mean rates didn't fluctuate a little bit, because in fact, the 5-year Treasury actually saw an uptick of almost a quarter point in first quarter alone. Now, remember, there's still a cost to safety, though. I know a lot of times when we see these headlines and with volatility, we want to just flock to the bank and put all our money in something safe and conservative. Right now, the national average, according to Barron's, for a 12-month CD is about 2%, a little less than 2%. The average money market's about 0.5%. Now, there's a lot of local community banks, credit unions, online sources that are paying much better rates than this. But just keep in mind, there is a cost of safety. Safety means there may not be any volatility, but at the same time, in a low interest rate environment, we're probably not earning that much either. Now, one of the headlines we've seen a lot about here recently is inflation. Inflation actually experienced a little bit of an uptick in first quarter. And that was mainly driven by the energy sector. We need to remember that volatility is part of a normal investment cycle. You know, we experience dips where the market drops maybe 5% or more. We experience that normally twice a year. And then a correction where the market maybe drops 10 to 15%. We experience that about every 18 months to every couple of years. But then a significant hit like a bear market where the market drops 20% or more, that's on average about every 5 to 6 years. So remember, the price to get growth is we have to experience volatility. Volatility is part of the normal investment cycle. It is very uncomfortable, but it's not uncommon. Now, if we look at the market over the past 10, 20, 30, 40 years, we can see where investors made significant wealth. But if you just look at this chart going back 40 years, there was a lot of volatility along the way. But you know what people care about the most right now is, hey, what about today's headlines? So the most dangerous words we can ever say when it comes to investing is, this time is different. And if we look at this chart right here going back over 50 years at different headlines regarding oil crises, we can see that we've been there before. So these headlines are uncomfortable, but drone attacks, the Strait of Hormuz, issues with Iran, just Middle East oil embargoes, these have all been headlines that we've seen over the past 50 years before 2026. Let's look at some sell-offs that have been tied to oil shocks over the past 35 years. Markets have actually rebounded fairly quickly over that time frame. So at the end of these events, if you look on average of that time period plus 2 days, markets were still down, close to flat. 2 weeks after the event ended, markets were still down, close to flat. 2 months after the events ended, on average, markets were up maybe about 1.5%. But what if you're more of a long-term investor? Most of you think long-term when it comes to investing. 12 months after these events, on average, the market was up 12%. 2 years after the events ended, on average, the market was up 32%. So patience and discipline pays off. So if we just look at the past 10 years of the market, and what if we pulled out because we didn't like the headlines? Now remember, we all know the saying, buy low, sell high, but human emotion of greed and fear can cause us to sometimes want to do the exact opposite. It can cause us to sometimes maybe want to sell low, and then buy high? When we get out, something bad's probably happened. And usually if that happens, somebody doesn't want to get in until it feels good. Well, it probably doesn't feel good until it's gone back up. So what happens if we do get out and we miss just the 10 best days, just 10 days out of the past 10 years? If we had invested $10,000 and just left it in and wrote out all the ups and downs, we'd have $33,000 today. But that $10,000, if we just missed the 10 best days over the past 10 years, we'd have almost less. We'd have just a little over $17,000. And if we missed the 20 best days over that 10-year period, we'd have a little over $12,000. And if we missed the 30 best days, we'd actually have less than our original principal. And if we missed the 40 best days, we'd have even less. So sometimes the best thing to do is to stay the course. As difficult as it is, timing the market can be very costly. Who is the leading provider of oil and gas? I know a lot of folks would think it's probably a country in the Middle East, but it's actually the United States. The United States represents 22% of the global share of oil and gas. Followed in second place, less than half the production is Saudi Arabia, then Russia, and then Canada. Now, what are our takeaways? Volatility remains. You're always going to hear us talk about volatility because we help you with investing. Volatility is just part of the normal investing cycle. We know it's uncomfortable, but it's not uncommon. The Fed kept rates the same. Inflation numbers have gone up. Bonds have had a little bit of volatility. We're going to continue to monitor key economic indicators out there. But look, you've got to focus on the long term. You've got to stay disciplined. You've got to stay patient. And you've got to stay focused on your goals and objectives. But know that we at Steward Wealth Strategies are here for you. So if you have concerns, if you have questions, please reach out to our wealth management team. Let us serve you during these difficult times. Now, if you have friends or family members that you think need to hear a second opinion, because this is a time where a lot of other folks in the financial industry will prey on fear, please keep us in mind. Our best clients come from our existing clients. So we would love to offer a second opinion. Be an SWS ambassador. If you have somebody you'd like us to meet with and we actually meet with them, you'll qualify to be a Steward Wealth Strategies ambassador. Also, if there's a group that you care about that you think would love to have a speaker, maybe you're helping facilitate FPU, or maybe you're a member of a retiree group that would like to have a speaker come in to talk about what's going on in these times, please keep us in mind. We love and really appreciate our clients as well as our SWS ambassadors. Please continue to follow us on social media. There's a lot of good that happens, a lot of fun that happens here that's not just involving financial planning. And I just want to close out and say thank you. Appreciate you joining me for a few minutes as we just give a quick update, but we also are grateful for your trust. It's an honor to serve you, and God bless you.